talking about the final steps of requesting a disbursement. I just want to welcome everybody. Before we get started, my name is Caitlin Mulhern. This will be my 4th year running the Equity Builder program and housing our workforce. I look forward to working with everyone this year. And we are going to have a little bit of repetition if some people took the enrollment training, just to kind of go over the workflow. But this training will be about the disbursement requests once your organization has table funded the grant. I do have a question already. Hold on one second. All right. Sorry about that. All right, so like I said, we do have a very packed agenda. So we're going to be talking about all the compliance information from the closing and post-closing, and then we're really going to go over the 5-year retention period in today's session. So when you're looking at the whole workflow of how to maneuver the Equity Builder program or the Housing Our Workforce, at this point you're at the disbursement level, but just to kind of give a high level, when your organization feels that they have a home buyer, they're making sure they have all the appropriate documentation and that you are going through the online platform, and that is the community lending login, and they're submitting all the appropriate documentation, income related, which is the enrollment process. We go through our 2-tier review for all processes within our platform. And then when your organization is approved, you are then able to close on your grant, and then you will be table funding the grant. So making sure that you have everything that ties out. And then once you have all your closing documentation, from the post-closing standpoint, you're going to be requesting the disbursement, and that's the reimbursement of the grant. And that is also a 2-tier review. So it is 20 business days for us to fund your Ideal Way account with us. We build in an extra 5 days compared to the enrollment, just because sometimes depending on the amount of volume that we get, especially with closer to month end from a reconciliation standpoint. So for something to kind of keep on your radar when you're communicating with your accounting department, if they're asking, you know, where is the reimbursement of the grant? So it's really important that when your organization is administering these grants, whether it's at the enrollment or the disbursement part, is really just to have a strong channel of communication and really making sure that your 2 contacts that your organization has established is the gatekeeper, if you will. They're going to get all of the emails and correspondence. So from the disbursement standpoint, if for some reason we need more information or we are funding your Ideal Way account, those 2 main contacts are going to be receiving all the correspondence. And they really should be the main point of contact, especially for your organization. If you have those 2 main people, but maybe there are other people behind the scenes compiling the documentation, they're going to really be your go-to person. And if for some reason those contacts ever need to change during the program year, it is perfectly fine. You can just reach out to me, especially if you have turnover or maybe who you establish at time of application you don't really feel is a good fit. We can always change it. You're not married to it. I do have a question already, though. Who would normally request the reimbursement, the post-closer? That's a great question. So honestly, it's however your organization wants to administer it. We do recommend people who are better suited and acclimated from the closer, post-closer standpoint or servicing, because you're really going to be sending all of the pertinent documents that are executed at the closing table. So we don't necessarily recommend an underwriter or a loan officer. However, we have a variety of larger banks and credit unions, so we really look to your organization to determine who you think is a good fit. So I hope that answers your question. All right, so when you are going through the disbursement, it's very important that you know that you're table funding the grant. So really making sure that all the documents from a closing standpoint, once you've gotten your clear to close in your first mortgage, are going to the closing table. So we do have our own mortgages and notes for EDP and how. They do need to be executed, and our mortgage does have to go on record with your respective registry of deeds. Something to note, we don't have access to the registry of deeds. We lend in 6 New England states. You are technically the lender of the first mortgage financing. We're only the funder of the grant. So it's your responsibility to be able to provide us that documentation and evidence that everything has gone on record. And when you're doing the disbursement, you can't email us the documents. We also don't need any hard copies. Everything's electronic. So if for some reason you have all these documents and you don't know where the original should go, you can keep them in your file. We do not need hard copies. I know sometimes the registry of deeds might give them to us. We don't do anything with them because we're all in our online platform. You're going to be doing it through the online system, which I had mentioned before is our community lending login. So if you are the person who's going to be requesting the disbursement, you're going to want a individual user account. And when you go into the platform, there is actually an opportunity for you to request if you're a first-time user. You can go through all the prompts it will bring you through, and you can be able to obtain your account. I recommend doing that where we've already been administering the program. That way, everything ticks and ties. It is a little manual on our end, so I strongly recommend doing that. And like I said, allow us 20 business days to be able to complete the disbursement review. And another thing to note is when at enrollment, if for some reason, depending on how far the file is, maybe you're in the process of having it underwritten. Maybe if for some reason a home inspection or an appraisal doesn't go well, and that home buyer has another property lined up, that's not a problem. You can switch out property addresses. You can't switch out home buyers for the grant. However, when you do receive that notice, you're going to want to make sure you update the change of address in the online platform as soon as possible, because if they're going into, let's say you're in Massachusetts and you're in Plymouth County, and then all of a sudden it is going to be somewhere out in Hampton County, that's very different income. So those are things that you just want to take into consideration. And, we're looking for you guys to use this program as honest as possible. If you know that a buyer doesn't have another property lined up and you're just letting that enrollment approval kind of sit, there could be somebody else who's fully baked and ready to go. But we do understand that, this is a really challenging market, and we do understand if these buyers and your borrowers are getting outbidded constantly and things of that nature. So, we will hold it within a reasonable time. Just make sure that the line of communication is open. So the documents that we require at disbursement is your buyer's closing disclosure. Something to note, EDP and how it is not a loan. It is a 5-year retention period, and it's a forgivable grant. So we do not require a separate CD. We also don't want you to label our grant as a loan. That's something that I really want to make sure is something that you recognize. What we do see and recommend, because we don't have our own closing disclosure, that you are putting our grant on page 3, and typically the same line items that you would put for a lender credit. Just make sure you're calling it the EDP or HOW grant or Federal Home Loan Bank grant if you don't know which grant that home buyer received. Just please don't classify it as a loan. If you do have other mortgages, for example, if there is a soft second that has a closing disclosure, we need a copy of that too. We need to just know where we are in lien position. We're not lien sensitive. We see a lot of home buyers layering us with a lot of products, especially with your state housing finance agencies. If you're in Massachusetts, Mass Housing and MHP, I know Chaffa has a lot of down payment assistance programs in Connecticut, as well as the rest of the New England states. We'll sit in fifth position, that's not a problem, but if there is a loan, we're gonna need that CD. I do have a question about lien status. If a loan, oh, actually I have a couple. If a loan program changes and the loan amount decreases because of the grant, do you need to review these changes? So that's a good question. That really depends on what program you're using. So we're going to get into the compliance parts of these programs with cash back and things of that nature. But a good example would be if you're doing a fixed 30-year fixed and it's a conventional, and then all of a sudden you're switching to an FHA. I would recommend reaching out to us and letting us know, because especially if you're using the HOW program, HOW can be used toward down payment only, and the way that FHA programs are structured, there's a base loan amount and then a final that has that upfront MIP. You're going to want to make sure that you are aware of the down payment only and using that final loan amount, because HOW cannot be used to finance that upfront MIP thresholds. So if you have any questions about that and you are drastically changing your loan program, please let me know. If your loan amount decreases, it kind of all depends. Like I said, depending on what program, there is a certain threshold of $250 cash back is the max somebody can get. And what if it is listed in the community second line? So we do see a lot of people listing us as community seconds, especially for HMDA reporting. There is no monthly P&I, so that's why I just want to make sure you're not classifying it as a loan. But when you're looking at it from Fannie and Freddie, I know that if you're using Encompass, for example, there should be a section where there's a community second checkbox or something of that nature. That's not a problem, just really making sure it's a grant. So you're going to submit either the EDP or HOW note. Our 2022 versions are on our website, as well as the mortgage. You cannot use any prior program mortgage instruments, because every year we are audited by the Federal Housing Finance Agency. They have very rigid recommendations every year. So we always refine and tweak our instruments. So that's why we cannot accept prior, especially because our templates are built and they say what year they received the funding. So if you ever have a situation, and more often than not, somebody uses a stale instrument, we're going to have it re-executed. For the mortgage, you're going to want to make sure you provide us a copy of that book and page of that document number within your respective registry of deeds. And we don't need the originals, as I mentioned. And if they're a first-time home buyer, we need a copy of the Homebuyer Education and Counseling Certificate. If you are, especially in the northern New England states, the education and counseling can be rather costly because they are a lot of affordable housing programs for down payment assistance. Sometimes they can be up to $500. If EDP is being used to subsidize that, we are going to need that counseling invoice and making sure that it is showed paid at closing on that closing disclosure. For EDP, we have evidence of a member concession. We'll talk about that later. And as I mentioned previously, if you do have other liens in addition to your first mortgage financing, for example, if there's an MHP1 mortgage with additional subsidy, we need a copy of those instruments. Like I said, we want to know what other down payment assistance and other liens, just to know where we're sitting in lien position. I just want to check if everyone can hear me. Someone just said they were unable to hear me at this time. Okay. I have a question. Can you confirm what you can use grant funds with FHA? So for FHA, we have no stipulation that you cannot use an FHA loan. There is just a component for the Housing Our Workforce grant, because we're going to go into that overlay for the HOW program, that it's for down payment only. There is the 2022 EBP deed restriction and EBP mortgage. We're actually going to talk about that later in the slides. So when you're looking at the closing disclosure, we're really just making sure that everything ticks and ties, just normal things that your organization would be doing from a post-closing standpoint, especially if you're selling on the secondary market, just making sure that the address, the legal address from the Exhibit A, especially if there's a condo or there's any sort of villages within the city or town that they live in, just making sure that everything carries through, verifying the sales price, looking at the earnest money deposit, what was at P&S, as well as does it match on the closing disclosure. As I mentioned, this is really important, especially for the HOW program, because it is a match program. We are going to talk about that extra due diligence later in this presentation. And then for EBP, if the member concession is something along the lines of a lender credit or a reduction of fees, we're looking for that on the closing disclosure if that's applicable. We're looking at your loan program, especially for ARMs. We will not accept anything that is under a 5.1, and our cap max thresholds are 2 and 6, so we won't do any 626 or 525s. Just something to note. And if you ever have questions about ARMs, please feel free to reach out to me. We're looking at your total loan costs. This is because the Federal Housing Finance Agency has something carefully written into our regulation that says we need to look and deem that the closing costs are reasonable. That's unfortunately very vague and convoluted, but we are looking at it from just the closing costs. So when you're looking at subsections A through C, borrower paid at closing, that's all we're really looking for, because we do understand that escrows can vary, recording fees can, things of that nature. So we're just really looking at that threshold. Our threshold that we have is a benchmark for the total section D is $3,075. If for some reason it exceeds, there is just a question that asks, why are they slightly higher? A good example would be if it is an FHA loan, that there's that upfront MIP. I know with interest rates being extremely high these days, people are buying down interest rates. So if you're charging points, we do understand that those things are there, especially if there's any higher attorney representation fees. Just make sure you're putting an explanation in there, and that is really, we're looking at your organization to vet those costs. And a regulatory hard stop is that they cannot receive more than $250 cash back. If for some reason if they are receiving more and you haven't closed the loan and you're doing a preliminary CD, we do recommend, first, we would say decrease your loan amount because we know that you're not going to want to decrease the grant. The buyer's probably going to want as much money for their grant. So just something to note. If for some reason you are at the closing table and you're realizing this, you can do a principal curtailment or a principal reduction. We just really want you to be able to communicate that to us in advance. We just don't want any surprises and things of that nature. But if you ever have situations like that, just reach out to us, please. So when you're looking at the EDP or How Note, like I said, they're on our website under the forms and applications. You're going to search for the respective program, and they will have a revision date of January 2022. Like I said, it's really important for you to know which program that your borrower is registered, because you can't interchange them. They're very specific about EDP being for certain income thresholds, as well as the How program being for a higher income thresholds. Making sure that your home buyers execute at closing, making sure that your names, your addresses, the grant amount, everything matches in the supporting closing documentation. And something to note when we're talking about deed restrictions as well as FHA. So our notes, when you look in this section, I have as an example in green, we have something in bold that says subordinate mortgage or deed restriction. We have that specifically if you have a affordable unit. So if it's in Massachusetts, it's a 40B, or there's, in the northern states, any affordability covenants, if you will. That's where your organization can make edits. So really what you should be doing, but we will still accept it just listed with both. The intent of it is it's either or. So it's either a subordinate mortgage because it's not an affordable unit, or it is an affordable unit and it's a deed restriction. So with that being said, when you're looking at our mortgage, we have a deed restriction that's for the mortgage. That's because of FHA having a specific template that they had ensured that the Federal Home Loan Banks would include to acknowledge some specific legal wording that's for FHA loans only. If it's not an FHA loan, you're going to use the standard mortgage template. And I will say we have had people reach out post-closing and saying that FHA has not accepted the instruments. That's because if you're not using the deed restriction, you're more than likely not going to be able to submit to that FHA portal. So same thing, you're just making sure that everything ties out. Make sure you're using current versions on our website. If you have any non-borrowers, spouses, or other persons on title mortgage deed, we recommend following standard mortgage practices and having them execute the EDP or How mortgage. Really just making sure that everything ties out, and like I said, making sure you're using the correct instruments. We do have one specifically for the state of Connecticut because they require two different individuals to notarize, and then the other mortgage is for the rest of New England. So when we're talking about the Homebuyer Education Counseling, this is for first-time homebuyers only, and at this point, your borrowers have already completed the education counseling component. So when you're looking at it from a closer or post-closure standpoint, you're going to have this certificate. But to make sure that this certificate is from an approved agency, they need to be affiliated with either CHAPA, HUD, or NICHE. And at one point, when your organization applied to offer these programs, if for some reason they didn't see somebody on this list, then they went through a separate process of having that agency vetted. So if anybody is not on this list, we do not deem it acceptable. However, I will say that there's a lot of subsidiaries throughout New England, and we do our very best by pulling from these 3 sites. But sometimes we might not see somebody on there. So if you ever have a question, please reach out. We're more than happy to do that, because this is a very manual process for us. When we're looking at the online education, We are seeing a lot of people using this instead of the 8-hour in-person, because we know in this day and age, it's really not just feasible for people, especially if they, have family, work obligations, etc. The only providers that we will allow are Framework or eHome America. We will not accept Freddie Mac or MGIC. I have Fannie Mae listed here because at one point Fannie Mae did have a small 30-minute education, and now they have actually paired directly with Framework. So that's the Fannie Mae that we're referring to. We do understand that they partnered with Framework to provide a very substantial online education. The reason why we accept these two providers only is we've done our due diligence, and they really do actually meet all of the homebuyer education and counseling standards. They go through the mortgage process, they go through the closing process, they also go through any other responsibilities that come with a home. It's not just a 30-minute quick visual of just the mortgage process. So that's why we allow those. We do prefer them to specifically pair with one of the approved agencies from these 3 resources listed here. And a good way to check to see if this certificate has done that is, here's an example from Maha in Massachusetts. It was completed with Framework. And what this buyer did is they got the code from Maha, they did the education online through Framework, and then they did the counseling, whether it was before or post closing. So we're fairly in trend with a lot of other state housing finance agencies. We at least need that post closing component, and we only require 1 adult household member. I have a question on the EBP mortgage. Will we remove the state notary section that doesn't apply? If that's something that you need to do, you are more than able to do that. We just have all of the New England states listed there just because we don't have them for every individual. The way we kind of see it is, if your organization lends in multiple states, we're not looking for you to execute the incorrect one. But if you wanted to edit the template specifically, if you're in the state of Maine, for example, that's fine. We have no stipulation of that, just really making sure that you're not ruining the integrity of the document. Okay, when we're talking about member concessions, this is for EDP only. It is not for HOW. However, we do see a lot of people who have asked, we're offering both programs, and to make sure we're giving the same treatment to our borrowers, is it okay to mirror this? If you want to, that's fine. We do get a lot of questions on that. The reason it's for EBP only is because this is a regulatory component that we have implemented with recommendation of the Federal Housing Finance Agency. So that's why it's not for HOW, because HOW is a voluntary program. Procedurally, it is similar to EBP, but there are some nuances that either we do carry over or we do not. So I just want to put that out there too. So when you're looking at the concessions, it's really important when you're in the online portal that you are explaining the concession. What is it? Where is it located? Please just don't say it's on the CD. A good example would be that on page 2 of the closing disclosure, section J, there's a general lender credit. Or, for example, if it's waiving or reduction of fees, making sure you're communicating our underwriting fee is typically $500. We are reducing it and only charging the EBP borrower $300. If you're doing below market rate, we do need a copy of the rate sheet showing that, say, for example, the rate is 5% and you're giving below market rate and you're giving half a basis point. We're then going to look at that closing disclosure and we're going to compare it to your standard rate. So you can't just say that you're giving a below market rate. We do need that rate sheet from your website. or if you're pricing it through your origination system, we need some sort of documentation. When I'm talking about expanded underwriting guidelines, sometimes this can get a little complex. I want to give some strong examples that we do talk about in our trainings. If you're doing expanded underwriting guidelines, a great example would be, you know, you're putting this in your portfolio and you have a minimum FICO score of 620, but you're going to allow somebody to have a lower credit score. That would be a good example. Maybe you have a threshold for loan to value. Our programs, we don't care about loan to value. We don't care about FICO, but maybe your max, you only take loan to values at 80%, but you'll allow somebody to go higher. That's really expanding your underwriting guidelines. Expanding your underwriting guidelines and saying that, you know, you're offering X, Y, and Z products and you're offering them to all your borrowers, that's not really providing them a concession. So when you're looking at the expanded underwriting guidelines, you're going to have to provide some sort of document, whether it is a printout of your procedures or your overlay matrix. So I would just caution, if you have those examples, to really make sure it's something that the home buyer is benefiting from. So for EDP only, it's really important, if you're going to be using EDP for rehab, 100% of the work has to be completed before your organization can request the disbursement. So I know that some people at the last minute, they might realize that the EDP funds were used toward that. It's really important when you're talking to your borrower, if you know that they're doing work, you know, if you're doing the construction loan, maybe you already know this up front. We do require the closing disclosure to evidence the escrowed funds. Like I said, 100% of the rehab work has to be completed, even if they're doing it themselves or a contractor. And when you are submitting the disbursement, when everything's done, we do have required documentation. And here are the examples, and they are also located in our policies and procedures. We need all the paid invoices detailing the scope of work. So we need to know that they've actually paid these. We're also going to want the evidence of the disbursement from your escrow account and the copies of the checks that have been paid to the builder, or however you're doing it. If you're giving it to the home buyer and then they're giving it to the builder, please talk to us before you close one of these if you haven't done that. And we're going to obviously want the final inspection that is evidencing everything's been completed. I do have a question saying, is the member concession still $250? So we don't, that's actually a good question though. We don't have a benchmark of if you're giving a lender credit or waiving or reducing fees. Every organization has, you know, different finances, so we don't stipulate the dollar amount. If you're questioning what your organization typically offers every year, feel free to reach out to me. And also, we have been transparent that at time of application, maybe for example, you wanted to offer $250 and for some reason it is lower. You're not married to what you put at time of application or even at time of enrollment. We're just using that as an exercise for your organization to appreciate that there is this extra overlay with the EDP grant. And then at disbursement, we're really looking for what is that final concession and where does that documentation lie? How long will you hold the grant funds for a rehab? We, the lender, allow a 12-month rehab period before final inspection. That's a great question. So I would say that would be feasible because technically with the Equity Builder program, the monies don't have to be dispersed by calendar year end. If you have a situation that you know it's going to be a 12-month rehab, just let us know. We'll work with you. We're not going to penalize a income eligible borrower because they want to use the grant for rehab. And one of the other questions about rehab is, does the supporting rehab documentation need to accompany the disbursement request? Yes. So that's a great question. This is an extra section in the community lending platform. When you select rehab, it's going to ask for all of the documentation listed on this slide, and you're going to go through that process. So if you do have any questions, please feel free to reach out to me in advance. I'm more than happy to talk offline about that, but I hope that answers everyone's questions. Okay, so an overlay with the HOW program. So it is a grant matching program. This year we did make some enhances to last year's offering of the HOW. We have reverted back, if you're returning to the HOW program, to a 2-to-1 match, because HOW is for down payment assistance only. It's a match program. So the example that we're giving here is going to follow through. So I think sometimes there's a bit of a complexity in how we're communicating it. And if you ever have questions, I just want to let everyone know, before you're closing, feel free to run the numbers with me. I'm more than happy to take a couple minutes to look at those figures before you close the grant, because I would never want your organization to be out any monies, as well as your buyer. So when you're looking at the 2-to-1 match, we're doing two calculations. One is it's a 2-to-1 match. So the maximum grant for this year is $20,000. So basing it that you want your buyer to receive the whole amount. If a home buyer contributes $10,000 of their own monies, so that's also something that's important to note. It cannot be a gift, and we don't have any stipulations if they receive additional gifts. It just cannot be factored into the HOW 2-to-1 match. So if it's their own money of $10,000 prior to closing, then they are eligible for $20,000 HOW grant. So that's something to really be important when you are communicating this to your buyer. And if for some reason, when you had taken their application or their purchase and sale, maybe you didn't know if they qualified for the Equity Builder program or how, we will accept addendums to PNSs. It has to be done prior to closing. It cannot be matched based on the cash to close. The reason is these closing disclosures constantly fluctuate. Loan amounts change. Sometimes purchase prices increase, decrease. There's a lot of things that we need to make sure prior to your organization closing the grant, because it's something to be mindful. You're table funding this grant. So at time of enrollment, if things have drastically changed for the HOW program, at time of disbursement, you would never want to be out the reimbursement of the grant. So this is why we have to get everything tied out prior to your closing, because the first layer is that 2-to-1 match. So if for some reason that $10,000 turned into $5,000, maybe it was a related party, maybe it was a rent to own, and they said, oh, you know, you can just bring the money at closing. Unfortunately, if that earnest money deposit goes from 10 to 5, your organization's only going to be reimbursed for $10,000. So that's why it's really important when you're looking at VCD that whatever was at time of enrollment, make sure it carries through. And if for some reason it doesn't, hit the pause button and please talk to us. The second part that's really important is how it's for down payment only. This is a voluntary program, so it's not tied to our regulation. So our board of directors really created this program in hand with our HCI team. And one of the parameters that they felt strongly about is this is to promote workforce housing. So it's for a higher income bracket. So these buyers are going to have a little more skin in the game. So it's for down payment only. It's really challenging for us to appreciate when something is for down payment only, and because it is done prior to closing, the best way for us to benchmark is looking at the purchase price with your first mortgage loan amount. So for example, if your purchase price is $300,000 with a first mortgage loan amount of $280,000, I'm going to pause right there and just say, in this example, you see that the home buyer has put down 10,000. When most organizations are at the loan estimate level, although we are not looking at LEs, you're factoring in that your borrower has put down that money. Because I see a lot of people who hit the pause and they say, well, if the purchase price is 300,000 and my loan amount is 280, is how being used, not just for down payment assistance. We have no way of looking at it at time of CD, so this is why we have to look at this benchmark before, and that's all we care about. If that $10,000 is used for closing costs, whatever, we can't go through the whole process of checks and balances and things of that nature. We're setting that as a threshold. So when you're looking at the HOW program, there's two calculations that we're looking at: the 2-to-1 match, which is that first example, and then that HOW is for down payment only. I do have a couple of questions. One is, one's just regarding 40B. If we have a 40B that's not FHA program, would we use your standard mortgage? Yes, you would. You would not use the deed restriction. The deed restriction is specifically has legal wording for FHA loans. You're going to want to look at the template and make an edit. It's either to the standard mortgage or deed restriction. If you ever have any questions, please feel free to ask. Also, something to note, please don't send both mortgages to closing. Sometimes we see people recording 2 mortgages because they're unsure of it. We don't want the 2 to go on record. So if you ever have questions, please just reach out in advance. Can a borrower use the HOW only to double their down payment, but also receive the equity builder grant? The answer is no, because EDP is for a lower income bracket and HOW is for a higher income bracket. So when you're at time of enrollment working with your borrower, you're going to know which program that your borrower is eligible for. They can't use both programs. So when you're comparing these programs, we'll highlight the things that really are pertaining to the disbursement level. For example, the maximum grant per household for EDP this year is $22,000. For the HOW, it's a 2-to-1 match at $20,000. EDP can be used for down payment and closing cost assistance, as well as rehab, if applicable. HOW is for down payment only. There is a 5-year retention period. It is for primary resident purchases only, cannot be for investment or second homes. And if they are a first-time home buyer, they do have to take the education and counseling. For EDP, the member concession or the incentive that we talked about to that home buyer, whether it's a credit below market rate, is for EDP only and not for HOW. HOW does have a down payment match requirement. One question about the HOW program or EDP actually, no asset restrictions. Great question. We do not perform asset tests. We don't care about assets. We don't care about loan to value, and we don't care about credit score. And one thing to also note, so EDP, the first 1/3 has to be for first-time home buyers. That's a regulatory requirement that the Federal Housing Finance Agency has administered on us. So your organization will target that. We do default to the HUD definition. They have not owned a home in 3 years. They're a single or displaced homemaker. And HOW that is not required. So say they're looking to buy a primary residence, they're looking to upgrade. Maybe they bought a smaller condo and they're expanding their households and they want to buy a larger property. They can't keep that property, that prior primary residence, as a investment property. They either have to sell prior to or simultaneous closing. So if you say that they're not a first-time home buyer and then they own a home, we're going to look for that documentation showing that they don't have two primary residences. How is it determined what portion of the $22,000 is used for down payment and closing cost assistance? Are closing costs covered first and remaining for down payment? So for EDP, we don't look at what is being used for down payment and closing cost assistance. There is no threshold of what that dollar amount is. So I hope that answers your question. And how is for down payment assistance only? So 2-to-1 matching. Borrower would bring $6,666.67, and the grant would be $13,333.33. Thank you very much for that very complicated scenario, but yes, that is the 2-to-1 match. So they have to put down that $6,000 and some change, if you will, prior to closing to get that 2-to-1 match. And if you have questions about the match part, always reach out in advance. So if for some reason at time of disbursement, we release the file back to you, we call that member action required. You are the member of our organization. And if for some reason we are either missing any documentation, we're going to send you an email. And some examples that we would put this in MAR would be if the final closing disclosure does not evidence the appropriate grant amount. Like I said, please don't list it as a loan. If we're missing a member concession for EDP, maybe you said you were going to give a lender credit of $200 and it's not there. Making sure you're using the correct EDP and note instruments with the correct year, the correct template. Sometimes, like I said, we'll see people using last year's or even 2 years ago, or if they were doing the HOW program, they actually executed the EDP. We can't accept it. We'll release the file back for that. If you've noted and we see documentation on your CD that there is other down payment assistance, we're going to need the documents for that. And sometimes if we don't have a copy of the education and counseling certificate, something to note that when you receive that MAR email, we allow 10 business days, and the online system will generate a email notification to your 2 contacts on the 5th business day to remind that there is outstanding items. Now, please note, we do understand, say something does have to get re-executed with your borrower, and we do understand that it's post-closing. Maybe there needs to be a Scrivener's, or well, actually a Scrivener's doesn't require the borrower to sign, but if for some reason you needed to do a confirmatory mortgage that you had to go back to your borrower, we do understand 10 business days to go to the registry and get that documentation is probably not going to be feasible. Just communicate with us and just let us know where things are in process. We really want to make sure that that line of communication is open, but traditionally we can't let these files hang out for 30 to 60 days, and that's something really important, especially with the rehab. Unfortunately, we have had people who have, for EDP, if they have selected that the use is for rehab and they submit that disbursement, for some reason they closed it, they didn't realize that 100% of the work had to be completed, and it's a DIY and it's going to take 6 more months. We don't love to have them hanging around, but that's why, just if you are offering rehab, just make sure you reach out in advance to make sure you're appreciating that extra layer. So once you have closed the mortgage, your organization, regardless of whether you sell your first mortgage financing, has to monitor these grants. That is a component that your organization has with us. You've signed an agreement saying that you're going to monitor for the 5 years from the day that you're closing that mortgage. So if that borrower decides to refinance, whether it's with your institution or another one, you have to work through the subordination process. If they are selling the property, you're going to have to go through that. We call that, instead of calling it a payoff, we call it a recapture, because we're recapturing the funds. And by the regulation, we have to regenerate those funds to other home buyers. We just don't take the money back specifically for EDP, because it is for low to moderate income. If a property is foreclosed on, it doesn't trigger a recapture. You do need to provide us documentation, because we are required semi-annually to document if any properties are foreclosed on. Sometimes we will receive notices because we're technically in lien position, but if your organization has been notified, please provide us that information and confirmation if that does unfortunately happen. Something to always note, no matter what happens with these borrowers, your organization is responsible to execute the discharge, whether they sell the property or the 5-year retention period is up. There is a way in our online system to pull a report of all the grants you have administered. I recommend that you flag these in your system of some sort. And we do always recommend that you kind of keep something on file for these borrowers, just so you know that you have this monitoring component, especially because these borrowers, once they're signing all the paperwork, they don't even remember sometimes where they got their first mortgage financing. Sometimes they even forget they have a lien on the property, although our EDP How disclosure does go through the parameters that we're talking about here when it comes to refinancing or selling. So you need to be the main point of contact and making sure that your borrowers know who to contact if they do refinance or sell from your organization. Naturally, sometimes these borrowers will reach out to us, or their closing attorneys will, or if they're refinancing the new lender, we're always going to assist and help facilitate, whether it's a subordination or a recapture calculation. But we're going to always bring them back to the main EDP How contact, because your organization, if they're doing a discharge or subordination, has to complete that from your monitoring component. So maintaining a separate file for that 5 years, like I said, if you have a way to flag it in your LOS system, I recommend that. Like I said, if you're using your community lending login, there is a way to pull an Excel spreadsheet, and that way you can look at when that 5-year period is still, for those borrowers. And I do recommend somehow, whether you have a paper or electronic file, keeping the mortgages or notes and that EDP How disclosure. It's really important to be able to keep that. Say that borrower says, I never received this grant. That way you can kind of say, well, we signed this, whatever, how many years ago, and you do have a grant, you signed and you complied, and there is a lien on the property. So when you're looking at the subordination, our process is very straightforward. We do not require an underwriting package. These borrowers can refinance as many times as they want during that 5-year period. The goal is not for us to take the money back. We promote equity in the home. So if they want to get a home equity line of credit to, maybe do some upgrades, any sort of need for a HELOC, that's fine too. We will sit in any lien position. As I have mentioned previously, we're not lien sensitive. No recapture calculation is required if they're going to subordinate. And we always say that is the most recommended. We don't care if they're doing a cash out either, but if for some reason your homeowner is required, sometimes maybe unfortunately it is a divorce or a severing of ties, and maybe they need to do a buyout, and that's when we've recaptured the funds. If for some reason, whatever first mortgage financing they're refining won't allow us to be a community second, sometimes that might trigger a recapture, but ultimately we recommend step one, can they subordinate? And it is just a subordination template. You just reach out to myself and the EDP How team, and I will provide the template for either the EDP or how they are two separate templates. And then you just submit that template to us. If they're going to a different lender for the refinance, you can leave that information blank, but your organization has to notarize and execute this document. So that's why, like I said, you're always going to be looped back in, even if you're selling your first mortgage financing. Allow us 2 business days because we have to send it to our legal department just to make sure that everything ticks and ties. All right, so recapture. So like I said, the best example would be for if they're selling their home. It's not a payoff. It's not as simple as somebody calculating per diem interest plus whatever amount they owe. It's a very intricate process that the FHFA has administered. The Federal Home Loan Bank of Boston always does this calculation. Your organization should never do this calculation. We do have this information in the EBP how disclosure. It is also it is kind of an abbreviated version in our notes under the repayment section. But here is the most high level way that I can explain what this transaction entails. So when we're looking at the protocol, the homeowner or the attorney should contact your organization because, like I said, you're the original lender of the grant. Sometimes it does not happen. They will contact us directly and we will reach out and put your organization in the loop because, like I said, you're going to have to execute the discharge. We're doing the calculation. We're going to need the most final seller's closing disclosure. And the calculation is based on a pro rata. So it's from the day that they bought to the day that they're selling. If it, for some reason, is a refinance, then it would be the day of the refinance. This calculation is very intricate. We now need to look at days versus months, things of that nature. But here is what the FHFA tells us for the pro rata part. So that is what's in our repayment section in the instruments. If this is for the Equity Builder program, we do have a proxy that they have recently administered that we have made effective, I believe it was the beginning of last year, for a low to moderate household. That does not apply to HOW because HOW is for a higher income threshold, so it has to be for EDP only LMI, and it's based on the subject property's location. So they have administered the HUD home purchase limits, and it's based on what county they live in. And if a say the maximum sales price for Barnstable County in Massachusetts is, I'm just making this up, $300,000, and they're selling it for $280,000, the grant is forgiven. So that's for EDP only if they're selling. The main part that has always been a part of our calculation is the pro rata. And like I said, I don't recommend anyone trying to do any of this due diligence on their own because it really is a very complex calculation. It's very regulated, which is why we don't allow our members to do them because they are highly audited. And the premise is never to really want to recapture the monies. It's to try to diminish anything that's due to us. So if you're looking at the pro rata because they either are not eligible for the proxy or the proxy does not eliminate. If the recapture is $2,500 or less based on that pro rata, nothing is due from the homeowner. If it is over by $1, we then go into a further intricate calculation that's based on household investment, looking at the net proceeds that they're getting. It's very complicated, but that's why we need that seller closing disclosure because we try to diminish as many monies, all the closing costs that they've acquired from buying and selling and how much principal and interest that they've put on their first mortgage. There's a lot of things that go into the calculation to try to either eliminate to get it to 2,500 or less, or to diminish it. They're never going to owe the full amount, because when you think about it, every year they live in the property, that pro rata is going to diminish. And this concludes today's training. As I mentioned, I'm Caitlin Mulhern. I am the Homeownership Set Aside Programs Manager. We do have 2 analysts this year. So our senior analyst, Kevin Ryan, this will be his 3rd to 4th year working on enrollments and disbursements. We actually have another analyst, Jack Newton, who joined us right before we kicked off the first funding release. My HCI operations manager, Lydia Bork, you might see her on some transactions as a compliance review. Paulette Bash, she's our CDA manager, but she does a lot of our administrative work with the GoToWebinar platform, as well as user accounts. And then you might see some notifications about the opening of our programs in the HCI department. Kenneth Willis, he's our Senior Vice President and Director. And I'll leave this open if anyone has any questions. All right, well, please reach out if you do have any questions along the way during this year's program year. I hope this information was extremely helpful, and we really look forward to working with your organizations. We've received a lot of reservations for EDP and HOW, and we hope that we can be a partner with your institution and providing down payment and closing cost assistance. Thank you.